Welcome, everybody. This is Axel Merk from Merk Investments. In the last several months, you have gotten to know Nick's chart books, and Nick, our senior financial analyst, has taken wonderful effort to dive into several different types of chart books, one on the business cycle, one on the S&P, one on the Federal Reserve, one on inflation. And one of his goals is to be as factual as possible. And he provides his analysis, but even with the analysis, he tries to not to overinterpret the data. And that's all great. That said, I happen to be somebody who likes to read in between the lines. And we often a tag team because I say, well, doesn't it mean this, this, and this? And then Nick pushes back, well, just look at the data. And I believe there is merit to both of these approaches. And what I'm doing today, and if we get good feedback, we'll continue doing that, is I'll take some of these chart books and then provide you my interpretation. And the goal here is not to necessarily disagree with Nick, although at times I do that. And I try to give him substantial editorial freedom here, so whatever he writes is not necessarily my opinion, but it's really to kind of provide the context that goes beyond the charts, that whereas Nick wants to make these charts speak for themselves, I try to link them. And so up to you whether you appreciate that or not. It's a different way, and that's also why we keep it separate. And I give you this here as a separate add-on, so to speak, and you do with that as you wish. And so maybe to kind of take a step back here on why the business cycle is important, and we've said that the first time we presented one of these charts, the key reason here is, of course, that historically speaking, the stock market has done substantially better during economic expansions rather than during recessions. And so that's one of the reasons why you might want to know it. You might want to know where we are in the economic cycle. And the question then is, of course, you might have different investment strategies. You might say, all right, I think a recession is coming. I'm going all to cash, or I'm reducing my stock position. That this doesn't tell you yet what to do, but provides context. And different people will use this sort of information differently. The other way, and we don't talk about it as much here, is that historically, of course, the Federal Reserve has started to lower rates. And so it means not just things for the stock market, it means things for the bond market, most notably short-term interest rates. One can take positions on where short-term rates might move. You don't do that typically with the standard instruments available in the markets, but here at Merck, we do that in some of what we do. And the one thing I should mention here is, as mentioned on the chart here, you can have a bear market in stocks without there being a recession. The 87 crash is mentioned most often here. And so this is just one of the guideposts here to look at things. Leading economic indicators, I don't need to tell you anything that's on the chart already. Economy with the economic stimulus has been accelerating. A comment on the steepness of the yield curve. On, I believe it was May 2nd, we published an insight. We actually co-authored it, Nick and I, to explain this mesmerization with the flattening of the yield curve. And while that is important, what is very important to keep in mind, the yield curve has been flattening for years. And the mere fact that it is flattening does not mean a recession is imminent. And so once you have an inverted yield curve, that's a different story. And so by all means, it is important to watch it, but the mere fact that it's flattening does not mean, oh my God, you have to run for the hills because the recession is coming and the world is ending. So to keep that in mind, that even though financial media are very focused on it, keep the context in mind. Purchasing Managers Index here is doing well in the US. Having said that, global PMIs, numerous people have pointed out, they've been weakening. As Nick points out here, the Russian PMI has come under 50. And here again, the question is, should you be concerned once, as Nick points out here, some of the major economies fall below 50, or do you want to be concerned earlier? And the challenge, the earlier you are, the more likely it is you might be wrong. But at the same time, if you hold cash, well, you can lose your purchasing power. And with perfect hindsight, I'll tell you exactly where things have gone. So again, different investors will use this sort of data differently. Now that said, historically speaking, and in the context of looking here at the business cycle. When these things are above 50, well, things are still expanding. And so that's why when a new data point comes out, it's often good to look at multiple data. But if you're a day trader, this probably doesn't help you too much. And at the same time, certainly the business side of chart book is not intended for day traders. So this is intended to give you a broader point of view. On the unemployment, this is a chart we see in different forms in different places, that obviously unemployment rate has been falling. And in this case, we have a moving average depicted here, whether we might again, we might pick up on the business and on unemployment again. Now, here is one of the areas where I like to quote unquote read in between the lines or go beyond here. This is clearly a business cycle chart book. Earlier in May, we published a Fed chart book, and a new one is going to be forthcoming soon. And one of the charts in the Federal Reserve chart book is a chart on the prime age male labor force participation rate. Now, that's a bit of a mouthful, but it shows how many people are potentially on the sidelines. And we all know that the labor participation rate has generally been declining. If you look at just the men, it's more pronounced, and we think it's important to look at that simply because you see more of a sensitivity there. The non-farm payroll report we just had recently showed that there wasn't an uptick, but you can't read too much into kind of the month-by-month data, look at longer-term trends. The reason why this is very important to me is because it then relates to this other thing, the slack in the economy. How much can this economic expansion continue? Many people have been surprised that it's been continuing so long. And so one of the things I watch is how much pressure is there to kind of resistance, as in how many people can you still draw from the sidelines? Are inflationary pressures picking up? And I'll make a comment on that here in a second. Let me just comment here on one other item here. The GDP Now forecast, that's an attempt to kind of have almost real-time information on where the GDP growth may be. We have an economic stimulus, so things are accelerating. I've been asked recently on CNBC Asia about, all this trade talk, isn't that going to be extremely bad? And one of the reasons why the markets have been shrugging it off, and I believe it's been shrugging it off, I happened to be there on TV the moment when the market was down. I think Dow Jones was down 150 points or so. That is not a dramatic sell-off. That's just a blip in the data for that particular day. But trade is a small fraction of the U.S. economy, and of course, there is a risk that it's going to escalate. Anybody, in my view, who wants to kind of have an idea about where this trade policy is going to go should read The Art of the Deal. That's Donald Trump's book from the 1980s. That will help you understand the thinking of Donald Trump. He is somebody who likes to corner the other person and then, out of a position of strength, to strike a deal. Well, in this case, it seems like he wants to have a quote-unquote crisis, a miniature crisis, to then resolve it. And obviously, when you're playing with fire, it could end anywhere, but at this stage, it's a small portion. Also, keep in mind who is negotiating with, right? Some of the disputes are with Canada and Mexico. Well, then advanced stages of the NAFTA discussions. My guess is they'll come to an agreement. In contrast, the European Union, the Europeans are too bureaucratic to quote-unquote strike a deal. So that's going to take much, much longer to resolve, in my view, because they're just not flexible enough to deal with the sort of breathtaking changes in policy. I try to phrase it as neutrally as possible. And so that's going to take a little longer, but still as a percentage of the U.S. economy, all these are fairly small. And so in that context, the economic stimulus that's provided, part of the tax reform, has a bigger impact, and that's why for the time being, the GDP Now forecast is high. And in my view, what's going to bring this cycle to an end is the same thing that brings most cycles to an end, which is inflationary pressures increasing, the Federal Reserve tightening as a result, and tightening to the extent to slow down economic growth. That soft landing scenario that's sometimes happening is more often a matter of luck than not. Of course, you can always have a shock that changes that. I'm going through these here. Let me just mention here one more thing on the lending standards. In the late phases of an economic cycle, lending standards often ease. And the reason is that the economy is doing well and banks are eager to make a buck. And so the worries about the previous recession are gone, and so you ease lending standards so you can do more. And that is precisely why then the Federal Reserve comes in and hikes rates further. The very point of hiking rates, of raising rates, is to slow down the economy. And at some point that will happen, and then, yes, then the economy will slow down and potentially roll over unless the fine-tuning is so brilliant that it's not going to roll over. We look at the high yield spreads as many other people do because that is where you see tensions in the markets. Now, let's keep in mind that we've had some issues in parts of the bond market. Part of Nick's goal is to have a consistent set of charts. And you may always find a segment somewhere, and you can have the attitude, oh, you want to find a canary in the coal mine, or you say, hey, let's look at what's important, and that's the high yield sector. The area that has had some tension is the bottom end of the investment grade market. And the common explanation given for that is that the type of investor is very important. So the high yield investor is somebody who is willing to take on some risk, and nothing really has changed that too much, including what's happened in Italy, and I can spend a second on that in a second. That said, on the quote-unquote safer end, if anything can be construed as safe, well, treasuries are yielding a good chunk of change these days. And so you might, and then also Treasury is issuing a boatload of debt. And so you might think twice about going down the credit curve where you're just getting a tad more yield on the investment grade side. And that's why that particular segment of the market has had big issues. Now, the reason I mention Italy is that, as you're well aware, I would think, we've had quite some turbulence in the Italian bond market. Some of that has abated. And the key thing here is that investors were buying securities that they were deemed safe. The same sort of thing that has happened over and over again in the financial crisis. Investor holding things that were seemingly safe only to realize that they're risky. And so in the case of Italy, it is, well, people were chasing yield. Why buy a German T-bill when you can buy an Italian T-bill, or Italian bond versus a German bond, right? And then suddenly people realize, oh my God, Italian bonds are risky, and those guys run for the hills. Now, when somebody sells a bond, there always has to be a buyer, and these things don't dissipate. And so the new buyer then coming in is somebody who is risk-friendly, and they're willing to pay for an extra yield. I will buy an Italian bond, right? And that's a much healthier environment. You get these tensions, these pressure cookers, I often refer to them, when you have the wrong types of investors in a security. And of course, yes, that can happen in the high yield segment as well, that we see depicted here, but it hasn't happened yet. If it were to happen, where people say, I am not getting compensated properly for this, and I don't want to chase yield anymore at 3.5% or whatever it might be. So Nick puts together this scorecard, and we're trying to aggregate that here internally into some ideas onto what actually to do with the investment portfolio. I'm not going to get too much into that here, maybe some other time. And one thing that Nick and I discussed on the summary is, let me just highlight that. Here we go. Some suggest the economy is potentially operating above capacity. All right, and then he goes on to say that it increases the recession risk over 1 to 5 year period. So I tell him, well, why are you talking about 5 years? Is anybody interested in what's going to happen over 5 years? And he just points to the facts, right? That even a economy that's late in the cycle, you just don't know about timing, even if it were to run above capacity. Now, my approach is more to say, well, if it's running above capacity, what are the implications? What else can happen? And that's, of course, not the purpose of the chart book itself. But the one thing I've alluded to it already is that, well, what about if you have that labor participation rate that is no longer to bump too much higher, which is breaking above the kind of the longer term trend line, something that we point out in the Fed chart book is something that Powell, the Fed chair, might be watching. And to me, these wage pressures are increasing. They're going to increase significantly in the coming months. And that to me is, at the very least, might suggest that interest rates are likely to move higher than is currently priced in. And here we go. That might be a trading opportunity. Get in touch with us if you want to learn more about how to potentially take positions on that. And so there are some implications here. And of course, if interest rates were to move higher than expected, well, maybe there is going to be more headwinds to quote unquote risk assets. The reason is that when you have interest rates move higher, that means future cash flows get discounted more. And so that's, by the way, one of the reasons why I historically say gold can do reasonably well, even in a rising rate environment. On the one hand, if real interest rates go up, then that's not good for the price of gold. But if real interest rates don't move much higher, especially if interest rates only go up because inflationary pressures go up, or if you have increased volatility because of rising rates, well, gold doesn't have cash flow, and so future cash flows don't get discounted as much. So those are my 2 cents. Here's some disclosure for your consumption. Give us some feedback on how you like those my take additions. And again, the comments that you saw, they are written. There were those by Nick, and the narration obviously is by me personally. This is Axel Mark from Merk Investments, and look forward to communicating with you again soon.